Testing. Hello. Okay. Thank you for attending this demo class. My name is Eric. Just a bit self-introduction to all of you. I'm now working in a family office looking after alternative assets. So before joining this family office, I was with a leading private bank and also a leading global assets management company doing hedge fund due diligence in both investment operations. So maybe we can go to the first topic. The reason I choose hedge fund is mainly because hedge fund represent around 35% of the total curriculum in level 1. So that's the reason I choose hedge fund. But doesn't mean that other topics are not important, right? So I think the first thing about hedge fund is many people compare hedge fund against mutual funds. And there are a few differences between these two funds. In KAIA, it has identified 6 key areas that distinguish hedge fund from mutual funds, and I will go through this one by one in detail. So the first one is about hedge fund, a private investment vehicle for qualified investor. The two keywords here is private and qualified. So private means that so when you want to buy a mutual funds, basically you can actually walk into a JF or Fidelity or walk into a retail bank to buy a mutual funds. But for hedge fund, basically is a private placement or private offering that if you want to buy a hedge fund, basically you have to buy it through a private bank or through a financial intermediary. So the second difference is the qualified investor. I think the qualified investor means a professional investor. That means that you have to be rich enough or wealthy enough or experienced enough to invest into hedge funds. So basically the guideline is if you have a net worth of around 1 million, then you are classified as a professional investor or qualified investor. So that's the key points for this first difference. The second difference is hedge fund portfolios are more concentrated. What do you mean by concentrate, right? So let's talk about mutual fund first. Mutual funds, according to SFC guideline, basically the major positions or top largest positions has to be less than 10%. But in hedge fund, the investment men, they are more flexible, and for the largest positions, it can go as high as 20% or even more. So it really depends on the manager's conviction. So that's the second difference. It's more concentrated in the sense that higher risk but higher return. The use of derivatives. Again, I'm using mutual fund to start first. I think there's a very tough regulations to regulate the usage of derivatives. I think in Hong Kong, the usage is mainly to hedge the portfolio. But in hedge fund, many hedge fund managers use derivatives to take positions, to hedge positions, or to generate some additional income. For example, writing out the money options, right, to consistently generate some premium profit. So the regulations for the use of derivatives in hedge fund is not that clear. So that's why people think hedge funds are more risky because of lack of regulations. The fourth one is the hedge fund may take long or short positions in securities. That's one major difference between hedge fund and mutual funds, right? I think mutual funds, they are all mainly long-only funds. That's why they call long-only traditional funds. But in hedge fund, they can actually build up a long book and a short book to generate a double alpha, right? So that's why you call a long-short equity fund as double alpha managers. We will go through one or two examples in the end of the demo to illustrate this point. The use of leverage, again, the mutual fund industry has a tough rule or regulations on how much leverage you can use. You can use leverage, but mainly for bridging loans or just to meet the redemptions for bridging considerations. But in mutual funds, the use of leverage, again, there's no hard rule stated in the private offering memorandum that how much leverage you can use. But normally in the industry, around 2 times leverage is the norm now. Maybe less than that now because of the deleveraging and the lack of investment opportunities. So the leverage is also one key difference. And the use of non-public securities. What do you mean by non-public securities? Public securities means listed stuff, listed stock, listed bonds, or other listed instrument. Non-public securities means non-listed stuff. Say, for example, convertible bonds, high yield, distressed credit, even private equity, right? So hedge fund managers can actually invest in the private equity style or pre-IPO, these kind of things. So these are all the key difference between hedge fund and mutual funds. And any questions so far? I welcome any questions about hedge fund or mutual funds. So on the strategy categorizations, there are 4 main base classifications. One is called market directional. So basically, the first one, as it mentions, directional means it's not market neutral. Somehow the manager has to have a conviction or make some betting or good bet to make the return. Market risk is the key word here, taking some market risk. Corporate restructuring, funds that attempt to profit from major corporate events. We call this an event-driven. Say a spin-off or reverse M&A, this kind of thing. In KAIA level 1, we'll go through more example, but not in here. Convergence trading, funds attempting some form of market risk neutral arbitrage. I think the most typical one is the fixed income arbitrage. What do you mean by fixed income arbitrage? Maybe just, for example, say long the first year T-notes and short the 2 years T-notes, this kind of fixed income arbitrage. So basically, they don't take any major market risk. They only take the basis risk, right? Between the LIBOR or the Euribor or this kind of Fed fund rate, this kind of thing. So they have to use lots of leverage to generate a meaningful profit. Opportunistic funds seeking opportunities wherever they exist. So this is a very general terms. So in KAIA, fund of funds is fall into this category. It's a very broad term. We won't go through that in here. So these are the map of different strategy. So opportunistic also include global macro. I think global macro, for example, the most prominent or the most well-known guy is George Soros, right? So I think he actually beaten up the Bank of England and forced pound sterling out of the ERM. So global macro, nowadays global macro is one of the most interesting investment strategy, because this year so far global macro is doing quite good compared to other hedge fund strategy. So these are the overall picture of different categorizations of hedge fund. Any questions? Now, I will go through 2 examples on the equity long short. One is called, it doesn't show up here, one is called the market neutral long short. The other one is just fundamental equity long short. I think maybe most of you, I will go to the internet first to demonstrate what actually is a market neutral long short, because it's better to show in a chart than for example, the example I will going to use is I think maybe some of you will have a knowledge about Sun Hung Kai, right? The issue about Sun Hung Kai in the last few months. So if I am a equity, if I'm a market neutral long short managers, this may be one of the good strategy that I would take to benefit from my views. So suppose if I'm I think all of you here understand that the Sun Hung Kai is actually suffering a scandal about the corruptions. So if I can construct a portfolio, a two stock portfolio, one is the long Cheung Kong, one is short Sun Hung Kai. So both stock are actually in the same sector, property developers. But if I want to eliminate all the market risk about property sector, I can construct a portfolio, a long and short portfolio. Oh, that's interesting. I try to compare the relative performance of Sun Hung Kai and Cheung Kong, and let me see whether I can do this in a chart. Interesting. Never mind. We'll skip through this. Basically, it will show up in here something like that. Basically, if you long Sun Hung Kai and short, if you long Cheung Kong and short Sun Hung Kai, basically you're removing all the property market risks, right? You will only take the commission call about that Cheung Kong will outperform Sun Hung Kai because Sun Hung Kai is suffering from the corruption scandal. So the beauty of this is elimination of all the market risks. Suppose tomorrow, CY Leung announce a tightening of the mortgage rate or mortgage tightening measures, that will actually hurt both stock, right? But if you long Cheung Kong and short Sun Hung Kai, you will eliminate all these market risks relating to the policy risk or this kind of interest rate risk. So that's the beauty of building a market neutral long short. And what about the traditional equity long short? The traditional equity long short is something like you have a views about one thing. Suppose you have a views about an economy is going to get worse, and you can do two things. One is short Cathay Pacific, and one is to long the fast food chain store, Cathay de Coral, right? Because Cathay Pacific will definitely suffer from the lack of demand from the business class or the first class, or the lack of travel demand, right? Because of the worsening economy. But on the other hand, the fast food chain store Cathay de Coral will actually benefit from the deterioration of the economy, because more people will actually go to the fast food chain store to fill their stomach, and also the rent that this company will pay will also be lower, right? So if you could construct this portfolio to express your view, then actually you will benefit from this so-called hedge fund strategy, right? So these are the wordings that I didn't show you, but I have already told you the example. So short selling involves selling a borrowed security with the objectives of returning in the future at a lower price. We will not go through this in this demo class very detail. The only thing is about that in Hong Kong, short selling, if you don't borrow a stock before you short sell, that's the violation of rules that you will be penalized by SFC. So there are many rules about short selling in both in US and in Asia. So activist investing. Activist means that they actually taking a different approach, say by appointing someone into the board of directors into the target company to turn over to unlock the value of the companies, to try to make things happening, right? So meeting with the management, requiring better corporate governance, implementing better business plan, or removing ineffective management, right? So these are the so-called activists. One last strategy is about corporate restructuring strategies. It's so-called distressed securities, merger arbitrage, event-driven, this kind of thing. These are all very popular strategy. We won't have time to go through all of them in here in this demo class. But for example, merger arbitrage is just like when there's a takeover or M&A, you basically long the target and short the acquirer, and try to lock in the premium, right? So there are so many more strategies that in hedge fund. I won't go through this. So these are the typical examples that you will see in the examinations. So the keyword in here is the most accurate. A few of them in these questions, in the answer, they are very similar or very blurred. But you have to pinpoint the most accurate answer. So these are the questions that you will actually face in the examinations, right? So I think I will leave this demo class in here. Any questions about KAIA level 1 or about hedge fund or about this demo class? I will welcome to take any questions on this demo class or other things. Thank you.